the investment angle. And of course, with the investment angle can also be used for trading, but it's not for intraday trading. So intraday trading is a different cup of league, where probably you don't need many fundamental information to trade. So we have discussed upon so many formulas and indicators which you can use for intraday trading. But generally, investment you requires patience, requires a lot of discipline, and some more resources than normal trading. So for those who are looking at returns which are something like 5 to 6% more than the FD, if you're carrying an FD which is 6%, then approximately you're looking at 12-13%. Then it is important to look at the equity markets, and also look at whether we are investing at the right time and at the right price. There are two different philosophies of investment. One is the you can't time the market, you do not know what the levels are. And another thing is that you get convinced that you are investing at the right time, and you are also investing at the right price and appropriate levels. Because investment and trading, in a way, you can segregate it like investment means probably investing in a business. Okay, trading, you are investing in a price. That is, you are doing it in a price, because you are just simply only following the price, and depending on the momentum, you are getting in or getting out. That is a trading. But investment, when you come, that is your great confidence in a particular company's growth, or on the index, which comprises of 50 companies, and then you know that probably this can give you a good return over a period of time. So that means you are also investing in a business which probably you are looking for a return which could be 15%, 18%, or 20% or so. So now how do you pick all these things depending on what sort of investment that you are looking for? First of all, you're starting with Nifty. Then probably you're starting with some sectoral indices. Then probably you're looking at the next 50, that is the junior 50. Then you are looking at some stocks. Okay, so based on this, you need a careful analysis to do all this. Now, one way to remove all these what you say is fallacies, or probably not getting into the controversy, or not getting into the problems of the justification of the fundamental values on which you are investing, then you look towards averaging it out at various price levels, which will take care of all these things. So you go for an SIP. And normally when you go for a systematic investment plan, there is always a chance historically that even 1-2 years sometimes can be a down period. That is, if you look at the entire bull scenario also from 2000 till now, there have been periods where probably markets were falling and also stagnant. Look at 2008 to 2009, that period. Then look at even 2012 to 2014, where we had up and down stagnant market, didn't give much of a profit. Then look at between 2016 to 18, where there was some falling market. Okay, then one crash in 2020. So these things happen even in a structural bull market. Nevertheless, the first justification for investment in any equity markets, particularly in a country like India, is the growth, is the country's growth. The macro, you come from a macro picture. And the macro picture, you know that India normally grows at 6 to 7% growth rate is almost there, almost every year. There is a general area of growth of 6 to 7%. That means when you are going at 6 to 7%, normally most of the top companies will also grow something like minimum 7% to 14-15%. So when you are growing at that particular pace of 10% or above every year, which could be in the form of top line, or it could be in the form of profit growth. So when you're growing at something like a 10%, 11% growth, you definitely have the equity markets also enabling you to grow at around minimum of 10 to 11%. Then of course that is the purely the growth in the economy and growth in the company's profits. That is, you look at the compounded profit growth or the CAGR, the EPS, whatever you have it. Then of course it is also can be aided by liquidity, because markets work on two principles. One is the fundamentals and the growth of an individual company, right? So fundamentals of growth, which is basically the growth. So how much is the profit growth coming, or the EPS growth? Okay. So this is one factor, right? So the EPS growth, the profit growth is very important. Second thing is of course the macro picture, which guides the liquidity situation, liquidity interest rate. So these both of them play a part. liquidity and interest rates. So this also helps in the markets climbing up or falling. Now, in the longer term, the percentage contribution of growth in the stock price will be done by the profit or EPS growth of the company. That is long term. If you look at 10 years, 5 years and all, generally speaking, the growth in the profit growth of the company or the EPS growth of the company will guide the major portion of the contribution of the stock price gain. To some extent, a fraction of that contribution will also contributed by what we call the liquidity interest rate expressed through a PE expansion. PE expansion can also contribute. So the market constitutes of two. The price, we have already seen that the price is equal to EPS into PE, right? EPS into PE is the price. So a major portion of a long term should be contributed by EPS, and to some extent it can be contributed also by PE in the longer picture. The shorter period, the EPS cannot keep growing, right? Every month, it's one quarter, you get the results. Okay, so there will be some expansion of the EPS, but this PE will have a very important bearing on short-term movements, which is correlated to the interest rate. Now, you get a lot of data prints, right? For example, you get a CPI inflation figure. Now, the moment you get a CPI inflation figure, the market assesses whether the interest rates are likely to go up or go down. Okay. Then you get data, and the data points whether the economy is likely to expand or probably economic decline or even recession. Based on this, you have a interest rate movement, which a market reflected interest rate movement comes in the form of in the G-Sec. In India, it's a 10-year yield is prominent. In US also, 10-year yield is a very prominent guidance as far as the market reflection of the long-term nature of the economy. So that can have a bearing on the PE, which can guide the movement in a shorter period of time. At the same time, the PE expansion, what is happening is historically right now, compared to 10 years back, the PE in Indian market has also expanded. The PE in the Indian market also has expanded. PE of many stocks have also expanded. For some stock, the PE is in for a very matured stock, which has been for many years. Then in that case, the PE settles around certain prices. For example, so we will look at three different, the index, we will also look at three different types of stocks, and also look at the present valuations around which it centers, and then say whether it is justified or not, because you'll always be having sound bites which will say it is expensive, it is overvalued, undervalued. So what all this means? Now, there is no clear one valuation metric which can say the market should be like this and apply the same valuation metrics to all the stocks or all the sectors. So it will always be very complex, which will involve a lot of data mining and judgmental issues. So that is why you have got a lot of fund houses, fund managers who use the technology as well as the balance sheet information to come to some conclusion about the price of a particular stock or the index value. But even there, probably the reason why we see the markets moving is it doesn't come to the equilibrium point. So whatever the judgment, it can be up or down to some extent. But what is very critical in that case, you may ask a question, then why should we follow all those things? Now it gives you some guideline regarding whether it's undervalued or it is overvalued, whether it is time to enter. So it will allow you to exercise a bit of caution as well as a margin of safety, whether there is some margin of safety in your investment. Now look at this situation where, just for example, the Nifty PE now is something like 22, right? Closer to 22. Now, if you look at the 5 years average, it is around 26, approximately. I'm saying 1 year could be 29.5. Okay, 10 year could be slightly maybe 23 or so. I'm not able to recollect right now. So 10 year could be something like 22, 23 levels. So now, if you look at it, probably this Nifty is now trading below the long term, medium term, and also below the short term, right? So what can probably make you think is that it came down to 20 recently when equity it fell down to 15,200. This was around 20. So let us say between 20 and 22, it will make you think that, let us say the PE now goes up from here to this particular level at some point of time or other. Now, when was it like this, and why should it be like this right now? So the question is, why was it like this, and why is it like this? This is reflected by the interest rates to some extent, because the PE is also to some extent there is a strong correlation between the PE as well as the 10-year yield, probably in US, and so whenever there is a correlation there is a correlation here also. So the correlation very clearly states that for every percentage gain in the interest rate, or as the interest rates climb, the PE falls. Okay, the PE falls, and as the interest rates go down, the PE rises. Now, this is a scenario where we have the interest rates rising. Okay, and it has risen by from 4% to 5.4% as far as the short-term repo rates are concerned. And the GSEC already moved from below 6 to around 7.2, today 7.2. It moved up to 7.35 or so. So there is a clear climb of the interest rates by 1.5% approximately in the last few months, and it is expected to climb a little more further. So as the interest rates climbed, we saw this PE coming down from, in Nifty PE was more than 30, S&P index was more than 26, and all these things started coming down. So we have the PE compression that took place, okay, is because of the interest rate. Now, if you expect now the interest rates now are going up, right? So it may go up for some more time, which means probably the PE around this level could be this. It can come down back to 20, and it can be 22. So if you get a feeling that probably at some stage the interest rate is going to peak, so that we do not know right now, but maybe after a couple of months we will know that interest rate tightening has peaked. When you know that, from there onwards, this PE expansion will again start taking place, and it may go to 25 to 26. It may go to 25 to 26. Okay. So when you get a feeling that probably yes, now this has come down from, so that means you will have a gain which could be 25%, but with what period is going to happen, within 1 year or 2 years, we do not know. But we are likely to get some of 20-25% growth in PE from this particular level. So you get one confidence level, that is, there's a margin of safety in investing when the PE is 20 to 22 levels, and it can go back to 25 to 26. Okay, which probably could mean good amount of profit to the extent of nearly 20%, 20-25% from these levels, right? Now, besides that, you will have the EPS growing. Now, let us say the last year EPS is now, let us say, approximately 750. And this is expected to grow by 13 to 14%. That is the estimate that they are giving, which means another 100 points. So next year by March, I think, or in 12 months from now, okay, so this was a March figure. So by March figure, probably we can say that by next March, that is March 23, it could be 850. Let us say the EPS could be closer to 850. So 850 is likely to be by March. So even if the index is to, if the PE is to come down back to 20, which means the interest rates are getting even more further tightened, or the market interest rates keep going up because inflation is not coming down, then still by March we can justify a 17K for Nifty. So this gives you the confidence that any investment that you do, probably below 17K in the next 6-7 months, will prove to be at least at break even or profitable. So you get a margin of safety by investing closer to 17K or below 17K. Okay, so this is what probably is the first, we don't need to be really a very big analyst to do all those things. What we need to do is that what is the likely EPS coming for the next by March or so. Then what has been the PE? Now, you know that the average PE, we have already shown you the Excel spreadsheet. This is the Excel spreadsheet which you saw last time, and right now we are again putting it for your view. See, if you see the 20 levels since 2016, there has been one or two data only which has been slightly below 19, so below 20, 19.34 in 2016, and 2 months back we had this 19.5. But on average, if you see any particular month, it is always traded above the closer to the in the last so many months. That is since 2000. That is, if you take the 22 years, the average will also be approximately 21, right? Because 21, 68, 45, and 21 above 21, slightly below 21. So it could be 20.5 to 21. Okay, is even the long-term average. So we are very closer to the long-term average of PE. So that itself means that you are justified. This PE is justified, right? Now, if you look at the 5-year PE, we are looking at something like average is 26 to 27. So there must be a lot of change because 20 years is too big a period. Indian economy has developed over a period of time, so we should be taking the most recent periods. And we are not taken 10 years. Now in this case we are taken 5 years. And in the 5 years we have seen the least is 19.5. The least that we have got is 19.5, which means there is a big amount of safety margin. So in the 5 years period we have seen some sort of an interest rate movement, pandemic, and whatnot, problems regarding the crude oil going up and down, facing a lot of problems. So 5 years is a decent period where we have seen a lot of issues come in the last few years. So that means we have seen the interest rates going down, climbing up. With all these things, now we have got a 19.5 has been the least, which must be the periods where we have seen an expansion as far as interest rates is concerned. So right now the 20 or 20 to 21 provides a very decent level for investment. It's a very justified PE as far as the market is concerned. That is what we are trying to say. So that is the easier way to find out from statistics that what is the justified ratio at which we can invest in the last 5 years. So let us say it comes to when you're investing at 20 to 21, then from there are two benefits that are likely to happen. One is the benefit of EPS expansion, and also it is going to be the PE expansion, right? So let us look at the markets right now. See, this is the of course this is a white background. I don't know, probably you may be able to see or may not be able to see. Very difficult for me to bring it to black background because we don't have the facility to change others' website into other colors. So this is the of course we have displayed it as far as Reliance Industries is concerned. So you can look at any search stocks. Let's put Nifty, whether we are getting able to get Nifty here. Okay, Nifty 50. So Nifty 50 is trading at a PE of 21.4. It is trading at 4.2 to the book value, and Nifty dividend yield is 1.3, and Nifty EPS is estimated to be 837.7. So right now, no, we are looking at the last quarter ended has come closer to 800 or so. So if you look at that, then the last trailing June till June it was 800. So 17,800 if the market is there divided by 800, we are talking about a P which is around 22 or so. So this is 21.4 they have put. So now let's say okay. So we will now look at the EPS growth. See, EPS growth. We'll look at last 5 years. Okay. So 5 years back, let us say right now we will take probably 5 years back, which is the this is the figure. Okay, so exactly 5 years back, 2017 August. So the EPS was 387. Right now they have put 800, 835, whichever way you want to take it. So you have at the time now 387. So let me mark that. For understanding purposes, I am depicting this now. So 5 years back, in 2017 August, EPS was 387 for Nifty. Now let us say it is around 800 to 835, so we will not go exactly into that. Okay. Now let us look at what is the Nifty price level at that time. Okay. So 5 years back, Nifty was, on this day of 5 years back, Nifty was 9,857. Okay. Now 17,900. 9857. This was 9857. And now it is 17,900. Right? Okay. So first of all, the EPS has grown from 9857 to 17,900, which itself is almost closer to the 2 times. Let's look at the PE at that time. So 5 years back, PE was 25 and now it's 22, right? So at that time it was 25. At that time, PE here was 25 and now it's 22. So there has been a compression as far as the PE is concerned. So let us say to what extent this growth in the stock price has been contributed by EPS growth, and to what extent the PE has brought it down from 25 to 22, right? So let's say approximately 9857. Now if you look at it, this is 800, because this is 800 is the present EPS, 387, and the PE right now is 22 compared to 25. So let's do this calculation. Okay, so 9857, 800 by 387 is 2.06. So 2.06 into 9857. Based on this should have been 20,375. Based only on EPS growth, it should have been 20,375. But what has happened is there has been a compression as far as the PE is concerned. Now that has come to 22 by 25. It is 0.88. So 20,375 into 0.88, let us say 17,930. So exactly we are getting that figure, right? Exactly we are getting that figure. Now that means EPS growth. Okay, EPS growth has contributed to a major portion, okay, of the stock gain. And the so 5 years, when we say 9857 has become 17,930, so that means let us say 17,930 minus 9857 divided by 9857. So 5 years has given a total absolute return of 82%. So maybe the compounded growth will be in 14, if you calculate, could be 14% or 13 to 14% approximately a CAGR. Now that has happened because there has been a slight compression to the extent of 15% or 10 to 15% on the PE, which over a period of 5 years comes to around 2% or so. It has compressed. Okay, so that means you have a less margin of safety and slightly prices are driven down when you are investing. Possibility. No, sometimes it can be the same. So the 25 PE probably can bring down the prices to some extent, not allowing the full potential of the EPS growth to be realized. So, but when you are investing at 20 PE, what happens is, one is the EPS growth you are going to get, and the PE expansion also that you are going to get. So what gives us the confidence if you are getting a 2021, if it's going to expand back to 25, it could mean a 25% growth there, which over a period of even 3 years could come to 7 to 8%. Now, the another factor is that the EPS growth. EPS growth, if you look at it, it has come to say 100% over a period of 5 years. So approximately we are getting a CAGR of 16 to 17% growth. So the EPS is growing approximately at around 16 to 17% CAGR. Okay, so I'm not giving you the correct calculation, but overall it is now one has become 2. It means 5 years 20% means the CAGR will be slightly lower. So over a period of 5 years. So now you're getting closer to this particular growth rate. Okay, so that means even if this is going to go down, to 12%, let us say over a period of time 12 to 14%, let us say it starts to go down. Okay, this is the CAGR that you're going to realize in future. But in 3 years, if this expansion of PE from 20 to 25 comes, or even from 22 to 25 comes, you are getting another 15% here, right? So 15% divided by 3 also is 5%. So you will get 5%. So you will get a growth rate which is 17 to 18%. So investors who are looking towards investing in the market should not look at the price peak, or price trough. I think you will be making a mistake saying that no, see 18600 is crossed, and because 18600 is crossed, it has become overvalued. So that is From the technical perspective, it could be which could reach to short-term pullbacks in the market. Okay, but taking a fundamental investment point, the most important points that you have to look at whether the EPS is going to go up, okay, and whether the PE expansion is going to take place or not. So these are two important things. And for in this, when you're doing for the index, because it comprises of 50 stocks, so the PE result is available for us over a period of time, which I showed you. 10 years average PE is so much. So how do you feel this PE is justified? That is the question. If the PE is justified, means that it should be closer to the long-term average. Okay, the long-term average for the 10-year average period is around 21. We are closer to that. 5-year is 26. 1 year is 29. So medium, short, and long-term, we are in no way at any great difficulty. So that means this is a justified PE from the statistical point of view. There can be other ways of looking at the whether this PE is correct or not, which I'm not going to go too much into fundamentals, because there are financial metrics which will call for what is the justified PE using a dividend model and all. So we are not trying to go into that. So the easiest way for us right now to understand is if it is whether it is settled down very closer to the long-term PEs. That is the most important portion to consider. And what is the likely EPS growth? What is the future likely EPS growth? For which you have to get information from the market, whether it's going to go 12%, 14%, or whatever it is, and look at the big stocks which are contributing, and what is those big stocks contribution towards the PE will be. Now, the big stocks contribution then could come from, now let us say Reliance Industries. Okay, this is one. Then probably HDFC Bank, HDFC ICICI. Okay, then probably Hindustan Unilever. Then like these TCS or some tech companies. Okay, so these companies will almost drive the valuations of the Nifty because of the weightage. Because put together HDFC, Reliance, HUL and TCS will be occupying something like 9, 18, maybe 25, maybe more than 35% of the index weightage could be coming here. So you know the major stocks which have the indexes, and see how the EPS is expanding, which will give you some information about it. Now Reliance, if you look at it, Reliance is expanding maybe at 25%. EPS is going up quite at 25%. TCS average dividend growth is going at 12 to 13%. Maybe, but EPS is going only at 8%. EPS is going only at 8%. Reliance EPS is going at 8%. EPS portion I'm talking about. I'm not talking about the dividend. I'm talking about the EPS situation, which is going up at this level. Then we have got HDFC, ICICI, Hindustan Unilever. So once you see this particular level, you know what is the justified PE for that particular company is, what is the likely EPS growth that has been, which will give you some indication. Let us say you take HUL itself. HUL is a very high PE stock. It is a very high PE stock, but it has remained like that PE for a long period of time. It has remained as a PE for a long period of time, whether you look at 5 years or look at 10 years. So let us see that particular graph of Hindustan Unilever right now. Now Hindustan Unilever. Okay. Now Hindustan Unilever, from all standards, is a very high P to growth, 5.82. Very high PE, which is more than 65% or so. It should be. So and the 1 year return is a little less, but price to book value is very high, which is 12.85. PE, trailing P is around 68. So the market right now we are speaking is only 21, 22 PE as far as Nifty is concerned. But you can see the Hindustan Unilever PE is around 68. But can you say that because it is 68 it has to come to 20 and then I will invest? It will not happen, because you look at the PE in the last few years. Now let's say PE, I will put it, and let's look at the last 5 years PE now. Okay, and even here we can go and to know the median. So in this Unilever, let's do the P ratio, and let's put a 5-year. Now this is a 5-year. Okay, and 5-year median itself you see is 67.2, and we are closer to that. 5-year median, we are closer to that. Okay, and 10 years, let us say, is 56.6, and that is where it came, very 10-year thing, when it came to that. See, 56.6. If you look at this was the in June it came down 52. It just touched that 52 in March. Okay, that's the time when interest rates are thing, but it did not sustain much for some time. So it came closer to the median PE of the last 10 years. So only somewhere in probably so in December 16 it was at around 42.3, and that has steadily climbed up in the last few years. From 2017 onwards, it has been above 45-50 levels, and that is why we see this 5 years average now climbing closer to 67.2. 3 years is 66.9, so it is settling. 3 years, 5 years, 1 year is 64.2. So all these things shows very clearly that a matured stock like this, so we have to look at the long-term average, which is the 10 years, which is 56. And right now, there is always a chance that Hindustan Lever can come down to below 60, 55, 56. That means we are investing at something like 15% higher as far as PE is concerned. But what happens is that what is the EPS growth that is taking place? Now, let's look at the Hindustan Lever. So, EPS. So last, let's say from July, we'll look at, there's something wrong here. So I think 2000, okay, September 2018, no, we had EPS which is 14.09, and right now approximately 4 years later, it has become 38.99, right? So 38.99 divided by 14 is approximately, you're getting a growth which is approximately 38 divided by 14 minus 14 divided by 14. So it is 71% an absolute thing, which on a period of 4-year period works out something like a 15%, 15 to 17%, right? So 17 to 17.5%. The CAGR will be approximately, it will be 13 to 14%. So the CAGR growth is 13 to 14%. That means the stock is can grow at a rate of 13 to 14% per annum. Okay, provided we are investing at a right PE. Okay, now the right PE, suppose let us say we are investing now at 66, and it falls down to 56. It doesn't. It comes back. Let us say 1 year later. The PE comes down to 56 or 57, which is towards the long-term average. Now the PE has come down. Let us say there has been for some reason or so, okay, but the EPS is generally still doing well, okay. So these things can happen because the PE is a factor of the interest rates. Also, I told you, and also sometime the systemic issues can come, or some pandemic situation which came like that. Some black swan events can pull down to some extent. Let us say the PE comes closer to the 57, but still what happens is if the EPS growth is maintained to some extent, the fall of 14-15% to some very large extent can be compressed by the growth in the EPS. Let us say the EPS has grown by 10% or so. So that means the fall in the price at which we invested could be only 3 to 4%. Assuming the same PE is going to be maintained, because we have seen the median PE being 66 for the last 3 years and 5 years. Good chance that probably over a period of 3 years and 5 years, it could still be at this level. If this is at the same level, then the stock would have compounded for the same profit growth, which is happening at 13-14% CAGR. We would have got something like 13 to 14% growth in the price. So this is how you make an analysis, and if there is a safety margin, you go for the investment. let us say the other one, screener. So here if you see, the compounded profit growth over a period of 10 years is 13%. Look at the stock price CAGR, 10 years is 18%. So in that 10-year CAGR, now the stock price 10 years is very much closer to the corresponding to that. It's just less than 1.5%, 1.5 times. So that means basically the profit growth has contributed to the stock price CAGR. Okay, and the 5 years is 16%. 5 years stock price CAGR is 17%. 3 years is 13%. That is also 14%. So this shows very clearly that the sales growth also of Hindustan Lever is going at 10%. Last 10 years it's going at 8% or 9%. 10 years the profit growth is also around 13%, which means that you are likely to get a stock price CAGR which is closer to the 18%. So this is the advantage of looking at the matured stock, where it becomes easier to look at it because there is not much of a change, because it's all very quite established. So because if you see the sales growth not giving any big surprises, the profit growth also not giving any surprises, that means it will grow very steadily at this particular price. But evaluating a growth oriented company is going to be a little more difficult. Now for example, Reliance. Now the Reliance Industries has grown. Let us say we'll put it the same thing for Reliance now. So Reliance Industries, we'll go to the big picture. Now 10 years compounded profit growth is around 12%. Stock price CAGR has gone at 21%, right? And the last 5 years, if you see, the profit growth is 14%, but the stock price is 28%. Okay, and the next 3 years also 14% and 28%. The last 1 year, if you see, it is correcting. Profit growth is 35%, but stock price is grown by 23%. So it has to eventually correct to some extent. Now the this particular thing which explains that the 10 years is a slightly good period for us to know that if it is going at 12% over this particular period, then it gives a return of 21%. So what we can expect is that probably the stock price, if the Reliance Industries is eventually to grow at something like a 12% growth over a period of time, we are likely to get something like a 20% growth in the this one, because this 3 years and 5 years has shown something like a double the amount. Okay, so let's not go for that, but larger term will be will get something like a 12% growth, unless the P P ratio to some extent can aid or can disturb depending on which levels where it were at some period of time. So 5 years back, let us say what is the PE here in this case. So 5 years back it was 17.4, and right now it is 27.3. So 27 by 17, it is 58.8%. So if you look at it, it's something like a 5 years means it's around it is contributing 11 to 12%. On a CAGR growth, this compensated for 7 to 8%. So that means when you look at the overall in this growth, okay, so in the last 5 years or so, this 28%, I would say 8 to 9% has come from the PE growth, from the PE growth. That means 1.5 times of the profit growth is generally what you can take if the PE ratio is going to be maintained. So the ratio of 27 to 28 right now, assuming it is going to be maintained at some stage, because let us say the last 3-5 years PE, now in this case in Reliance, the last 5 years average PE is only 23.5. We are trading much above that. So there is a risk of that falling back to 23.5. Then let us say the last 10 years is 17.6. So these are all things which tells us a possibility of some situation where it can get dragged down. Okay, in case if performance or something fails to some extent. So this 23.6 and 17.6 raises some alarm that we are trading at a PE which is much more than what probably justifies in a longer term, okay, or even a medium term of 5 years. So let us look at a 3 years period. 3-year period is closer to that. So last 3 years period is, so that means Reliance is slightly changed. The growth trajectory and other things seems to be changing, okay. So it is trading closer to the 29.1 right now. That means we don't have margin of safety from the PE levels are concerned. So we don't have that margin of safety from PE levels is concerned, because if it is eventually retraces to a 5-year median PE which is around 23, good chance that we may lose something like a 20% from here, 20% from here, and the profit growth as well. So there is a chance that if you invest here, if there is a fall, the next 1 year return could be bad. 2 years return at that time, if it is also false, then return may not be good. But in a 3-year period, it will start picking up. So if it is to achieve the 3-year mean period at some stage, then the profit growth will take care. So eventually we have a very much less chance of so that means we need to wait for some correction, which could be the 2200, 2300. That should be a fall of under 10% at least in Reliance, which should give some sort of a margin safety for us as far as the PE and book value is concerned. Now, as far as the Reliance is concerned, there are, of course, I told you there are many metrics to do that, and one is the price to book value. If you look at the 5-year, the median value is 2.2. Okay, now it is trading only at that 2.3. So 5 years median value it is trading. So from that level it can be justified. 3 years is also median PBV is 2.2, and it is trading closer to that, right? So 10 years 1.8. So median P the 10-year period may justify another 10 to 15% fall in Reliance. So I think from the longer term perspective also, the Reliance, if it falls, I would say by another 15% or so, which is with 300 rupees approximately. So anything around the 2223 levels offers a fundamentally a very good level at this place, because it will be close less than 2 book value of median book value, less than the median book value of the last 3-5 years, closer to the last 10 years thing. And though the PE may be at least it can be slightly below the last 3 years median, and slightly more than 5 years, but at least to some extent is a little closer to the 5-year median, we can say. So what it justifies is that from the price to book value, this seems to be okay. From the price earnings ratio, it seems to be slightly more requires some sort of a fall there. But the growth, if it is going to happen over a period of time, 14% or 12% growth rate, good chance that probably even with some PE adjustment, we will still have a 14 to 15% growth in the CAGR in stock price as far as Reliance is concerned, which means it offers fundamentally a good pick even now for a long-term investment compared to an FD. So this is how you make your own conclusions regarding this. So we will continue with this discussion even tomorrow. We will look at some samples, some more companies, probably look at TCS, Tata Motors, Tata Steel, a few more companies of how to pick these stocks for this investment. And also we will look at what is the correlation between the PE and the that is the S&P PE, US S&P PE, and the 10-year yield there, and also make some correlation study with the Indian GSEC, and get ourselves into a more confident mode as far as investment is concerned. Okay, so thank you very much for your participation today. So if you have any questions, please ask. Thank you. So somebody has asked what is the August Nifty trend. I think the trend is already up, so there's nothing to say. It's just a one-way streaming rally right now, and which has the 18,114 is the next level of resistance, and it has to at least get below 17,840, right? So this is 17,842, and today the low was around that. So it has to at least get back to slightly below 17,840 for a pullback, and then probably we'll have 17,600, approximately 17,600. So unless it is able to get below this level, which is 17,600, so 17,600 and 17,000 842, right? So the immediate trend is 17,842 and then 17,600. These are the places of support. One of this you can be used for your stop loss thing, and the moment now will carry it above 18,114. Now it has broken all these trend lines. Now if you look at the trend lines, it is above all the moving averages. Now it is, see, now this trend line also is broken, right? So this trend line itself will offer a support. Now since this trend line has been broken, we will see supports coming edging at on these levels. So the broken trend lines itself now will start offering support, and so at this juncture, no, probably there can be some pullbacks right now, because the US S&P also is closer to the big trend line. If you look at the big trend line, it's here. So probably we can see some pullback, right? It has come very closer to that. So this is going to be a very important place to watch for some correction that can happen, and it has to at least fall below this level, which is 43.07. It is going below that. So I think the next level could be this, right? So 41.80. So 41.75, 41.80 could be the important support, and a breakdown below which probably can take it a little lower. But right now it looks to be quite on the bullish side, and 4300 has to be, if it is crossed, if this eye is going to get crossed, which is the 43.25, then I think we are going to enter into a period of further bullishness in the market. That is from the technical angle. As far as the fundamental angle is concerned, I think the market is fairly valued, and in a situation like this, to get itself above the medium term fairly valued pitch in this is going to be a little difficult. So we should see some sort of a correction, and if at all a correction comes in S&P closer to 4,000, I think it could be a worthwhile investment from a longer term perspective. Okay. Thank you. So thanks for your participation. See you tomorrow again, the same topic, but using different stocks for the EPS, PE, and also we look at Bank Nifty also, then also the trend, then correlation with S&P with the US Treasury yields. Thank you very much.